Wonderful. Well, in the interest of timekeeping, I think we'll begin now. So yeah, thank you again, everyone who's joined us this morning. Good morning to you all. And on behalf of the Spanish Chamber of Commerce in the UK, we'd like to thank you so much for joining us for this webinar. Actually, I think it's the first webinar we've held in 2022, which is exciting, which we're really pleased to be holding with St James's Place Wealth Management, which is a relatively new member of the Chamber. And the topic of this morning's webinar is it's crunch time to get the most from this year's tax allowances. So we're really pleased to be joined by Luis Villar from St James's Place Wealth Management, who's going to be leading our session this morning. So I'll just now give you a bit of background about Luis as the speaker. So Luis is a financial advisor and chartered wealth manager that helps individuals, families and businesses achieve their personal and financial goals through bespoke, holistic financial planning and investment advice. Luis works with city professionals, CEOs, company directors, individuals, families and businesses, and his goal is to help his clients make well-informed, positive decisions that will stand the test of time. His expertise includes pensions and investment, protection, corporate financial estate and tax planning, as well as working with Spanish individuals and companies resident in the UK. At the end of this presentation, you will find Luis's contact details, so please do feel free to reach out to him if you have any questions about what's been covered today, or if you'd like to find out more about the services that his firm offers. And also, you might find that you have quite a few questions about the content that's going to be covered in this webinar today. So I'd like to really encourage you all. There will be dedicated time after Luis has finished the presentation for you to ask any questions, but please, as we go through, you can either use the chat function, you'll see at the bottom of your screen there. I'm sure by now you're very familiar with how Zoom works. There's also the Q&A function. Please do feel free to write in at any point that a question occurs to you, your question for Luis, and he will either answer it in that moment or at the end after his presentation. We have time for Q&A, but please don't be shy and please do write in your questions. We'd love to hear from you all. Great. Okay, well, without further ado, Luis, I'll hand over to you now.
That's great. Thank you. Thank you so much, Hannah, for your kind introduction, and good morning, everyone. Welcome to this presentation. We're going to be talking about quite a lot about tax today. I'm sure it's a very, very exciting topic for all of you. And yeah, thank you so much for taking the time to join me today. It is, tax is something that, it tends to be quite a bit of a concern for a lot of people. Sometimes it's often misunderstood, and it can lead occasionally to frustration and disappointment. So as part of this presentation, what I like to do is to walk you through some of the main aspects of the tax system in the UK, to give you an overview in terms of how things actually work, and also to give you a bit more of an insight in terms of the various different things that you could potentially look at to make the most of your tax allowances this fiscal year, which ends on April the 5th. So we've got quite a lot of ground to cover this morning, so I'm just going to get cracking with the presentation. And as Hannah said, there'll be an opportunity to ask any question that you might have at the end of the presentation. So I'll try to take as many questions as I can, and if we feel that we need to extend it or just need to have a separate conversation, that we'll be able to arrange that at the later stage. But let's start with the presentation now. Yes, tax is one of the greatest detractors from every pound in your pocket. So in a low return environment like we are right now, with low interest rates, although they're starting to creep up, it can be challenging simply to keep your head above water. And you add to that the fact that the tax levies that we face on income and capital gain, and even sometimes what we want to leave behind to our loved ones in terms of our inheritance tax planning, it's clear that the building tax efficiencies into your financial plan is really, really important. So today we're going to talk about tax planning and some key steps that you could potentially take before the end of the tax year, which can result in mitigating or reducing exposure to unnecessary tax. We're going to be looking at the use of the reliefs, allowances, and exemptions combined with effective and tailored financial planning and advice. Okay, so that's what we're going to be looking to cover today. Let me tell you a little bit more about myself. As Sana said, my name is Villar. I'm a chartered wealth manager, work for Census Place. I was born and bred in Bilbao, Spain. In case you were wondering, those two pictures on the right-hand side, they're from my hometown, 1980s. The one at the bottom is a little bit more recent, so you can see that the city where I grew up is changed, quite significantly over the past 30, 40 years. I think some people call it the Guggenheim effect, but yeah, that's where I grew up. Yeah, so in terms of the clients I work with, it's a mixed cohort of individuals, families, city professionals, as well as corporates here in the UK. I do a lot of work as well for UK residents, non-domiciled, Spanish-speaking individuals, as well as businesses. And in terms of the areas where I specialize, they're primarily around investments, retirement, protection, and estate planning. So my practice is Apollo Private Wealth Management, which is practice on Census Place wealth management, and offices in Canary Wharf. Right. So let's move to the next slide. Let me tell you a little bit more about St. Census Place wealth management. We are the leading wealth management firm in the UK in terms of funds under management. We have, founded in 1991, we're a FTSE 100 company, nearly 150 billion funds under management, as you can see, as of September 2021. And the financial advice that we deliver to our clients is through our partnerships. So we work very, very closely with our clients on an individual basis, and we help our clients to make financial decisions that will stand the test of time. Financial decisions, that the financial planning that works in the short, medium, and long term. We've got nearly 1,300 employees at the moment, plus another 2,000 partners that within St. Census Place that form part of St. Census Place Wealth Management. So yeah, we are, as I said, a very, very large organization, and it gives the opportunity for us to be able to offer a bespoke advice to our clients, in the sense that the way we work with the financial advisor is on an individual basis, but then the financial advisor will have the resources and the expertise available in-house to put together rock solid financial plans for our clients. So this is how we typically work with our clients, as I said, on a personal and business level, as well as looking at your planning objectives and your financial assets. And first and foremost, it's about understanding our clients on a personal level, but also on a professional level, as well as family level as well, if that is relevant. We look at the current goals and plans, challenges, where they are right now and where they would like to be, say, 5-10 years down the line. So we looked at the assets they have, expect to have, and when they would like to have them, how they use the assets, and how do we intend to use those assets in the future. Everything we do is goal-based, and it's very much about, as I said before, about helping our clients make well-informed financial decisions that will stand the test of time. Okay, so we help our clients to prioritize their objectives as well, or to think about the areas that they would like to focus on now and into the future. So, we cover aspects that are individual to each client. More often than not, we include families as well, businesses, and their careers. So we take a holistic approach to financial planning and investment management. Ultimately, it's about enabling the client to build a financial roadmap to get them where they want to go. and to work in conjunction with other advisors, such as solicitors and accountants, to ensure that the plans and solutions that we put in place complement one another. Maybe a note on the work that we do with the solicitors and accountants, and I personally work quite closely with both. One thing I found that sometimes people get a little bit mixed up is that sometimes they expect the accountant in the UK to be their financial advisor, and unfortunately, an accountant is not a financial advisor. So there might be really good tax planning opportunities, investment opportunities that you might miss out if you rely on your accountant to make you aware of those. So it is very important to understand the role of the accountants, as well as solicitors and the financial advisors, as part of providing a holistic financial planning and tax planning a strategy for our clients. Financial planning can be complex and onerous, and there's a phenomenal amount of financial solutions available out there, and can be really daunting actually to pick and choose the right financial advisor, the right solution for your own personal circumstances, and in a world where, of course, legislation and priorities are constantly changing. So I think from my perspective, being part of Sciences Places Management, it enables me to leverage the expertise that we have in-house, as well as the extensive network of solicitors and accountants that I work with in the UK, to deliver rock solid, bespoke solutions for our clients. So something really, really important, I think, to bear in mind when you work with an accountant or a solicitor or a financial advisor on a personal or business level. So tax planning, it is an area of very important area of financial planning. However, I think it's important to reiterate that the approach on a personal level and the way we approach tax planning, it can be done in different ways. What it might work for one person, it might necessarily work for another. We all have different goals and aspirations. Okay, so some of us might be non-basic rate taxpayers. Others might be exposed to the additional rate, currently 45% on income. There might be people who are actually more exposed to a potential capital gain tax liability on the sale of certain assets. And you might need help to plan the sale of the asset, or even before you go ahead with the sale of the asset, and understand your various different options. Or perhaps might be families that are exposed to inheritance tax in the UK, and is weighing heavily on your mind. So there are various different scenarios, and whatever the scenario, I think it's important to avoid the temptation to look for silver bullet solutions. Okay. It's not it's one size fits all, and it's not there isn't a magic silver bullet that is going to solve all your problems at once. Okay, it's often, more often than not, it's a combination of various different tools and strategies that we can put together for our client that will help you to get to where you want to get. And it is very important to take a holistic approach to financial planning, as well as to investment and planning and tax planning. So what we need to do, we need to understand, first of all, you need to understand your exposure to taxation. Okay, that's really, really important. How is tax, my taxation affecting my ability to draw a net income at the end of each month and at the end of each year? need to understand which reliefs and exemptions and allowances you're entitled to, okay, and how or if you are using them effectively. This is really, really important. And it's not just actually just about the exemptions or allowances, but also about sometimes this tends to get forgotten as well, the tax credits that are available by being a UK resident. Sometimes people forget to claim those. And again, it can lead to situations where people are actually, they find them worse off. And unfortunately, this is a little bit difficult to, to backdate. It might not be possible to backdate a claim, and the tax relief that it would be available, unfortunately, is lost effectively. So we need to look at the exemptions and reliefs and whether we're using them effectively, okay? And once that is achieved, then is when we begin to look at the more effective strategies to achieve, hopefully, a reduction in your tax liabilities. So, a very simple message, use them or lose them, okay? The cornerstone of a tax efficient strategy is to be aware of any reliefs, exemptions, or allowances, and ensure that they are used effectively. And as I mentioned before, you will lose some if you haven't utilized them by April the 5th. The fiscal year in the UK runs from April the 6th to April the 5th. So we need to be mindful of what is available, how we can use it, and whether it is the right time to use it or not on a personal level, okay? So it's really important to keep these considerations in mind. Okay, let's start with the ISAs. I'm sure some of you might be familiar with. These are individual savings accounts, okay? And there's very different options you can choose from. They were first introduced in 1999, a long time ago, and have since become a really cornerstone piece of the UK savings landscape. Okay, there are four main types of ISAs you can see on the slide: cash, stocks and shares, innovative finance, and license. Many of you, I'm sure, will have an ISA, but the question would be, which type of ISA do you have, and whether the ISA is aligned to your saving goals. Research suggests that most people opt automatically for a cash ISA, as HMRC figures show that the proportion of people subscribed to a cash ISA and stocks and shares ISAs between 1999 and 2019 is 90% stocks and shares versus 81% cash. So we need to ask ourselves whether having a cash ISA in your own personal circumstances is better actually than having a stock and shares ISA, or it could be the other way around. So the cash ISAs, again, is this the right home for your savings? Holding wealth in cash, as you know, is the right thing to do if it is money that you will need in the short term. The problem comes when cash becomes a long-term investment, and that is a reality for many cash ISA savers. If returns on your cash ISA savings aren't keeping up with inflation, then your spending power is reducing. With interest rates, as you know, are record lows at the moment, relying on cash as a key part of your longer-term savings strategy could be putting your future financial security at risk. So I guess you have to ask yourself, have you held savings in a cash ISA for more than 5 years? Do you know what rate of interest you are getting when you cash ISA savings? And when did you last review your cash ISA account? Since April 2016, most savers receive their interest gross of tax, regardless of whether they use the ISA allowance. So what does that mean for cash ISA savers? Basically means that your personal savings allowance should play an important role in determining whether you hold your cash. It enables basic rate and higher rate taxpayers to earn £1,000 tax-free if you are a basic rate taxpayer, and £500 you are a higher rate taxpayer every year. With interest rates at the current levels, the amount of cash savings on which you can earn tax-free interest is staggering. Of course, all interest from a cash ISA will remain tax-free. It's one of the beauties of the ISAs. Growth within the ISA is tax-free. In contrast, a rise in interest rates will reduce the amount in the standard cash accounts on which tax-free interest could be earned. However, there's little prospect of interest rates rising significantly in the next few years, although we'll have to see how inflation plays up. But it is another reason to consider whether cash ISA is the right place to save for the long term. So therefore, if a stocks and shares ISA might be the use of this year's allowance, you're investing for the long term, what are you going to do about it? The stocks and shares ISA provides the opportunity to generate both income and growth free from income and capital gain tax. This is really, really important. Some people might be put off by the name and prefer the perceived safety of a cash ISA. However, most are not aware that you can have a stocks and shares ISA that contains no stocks and shares, i.e. you could invest, for instance, in a collective fund, in property, bonds or gilts, or corporate bonds. You could invest in a blended portfolio that reflects your attitude to risk and to investment, but does provide the opportunity to take advantage of the two key tax breaks an ISA provides. The other naming conventions might trigger further confusion as to which is the right way to use this valuable use it or lose it allowance. Personally, I would argue that even for something as simple as using your annual ISA allowance, you should probably seek professional advice. Right, this is another variation of the ISAs for children. It's called a junior ISA, okay? And it's an area that I think is worth reflecting on for those of you with children or grandchildren, okay? Many of us have children, grandchildren, or other young relatives that we care about. And the junior ISA is a great way to contribute towards saving for education or getting the first car or even helping towards putting a foot on the property ladder, okay? You can invest up to £9,000 into junior ISA every year. And the gains will be free of income and capital gain tax, and the child will not be able to access the funds until it's reached 18. Many child trust funds were set up by banks and building societies, which confuses and frustrates most people. For what was often an 18-year investment, why wouldn't you want to build the potential real growth to at least cater for the impact on inflation? Okay, so this is an option that was available previously, but it wasn't tax efficient. So this is something, again, that some people have missed out on because they were not aware of the opportunities around junior ISAs. So let's look at we're sticking with the theme of tax efficient investing. So outside of the allowances like the ISA, there are still advantages to choosing an investment over a cash deposit. Okay, the first £2,000 of dividend income from a portfolio of shares or equity unit trust are free of income tax. This is the dividend allowance that we have every year. And thereafter, they are subject to either 7.5%, you're a basic rate taxpayer, 32.5% for higher rate, and 38.1% for the additional rate taxpayers. You also have an annual capital gain tax allowance or exemption of $12,300 this tax year. And there is a reduced rate of 10% for business property relief. Sorry, and this a reduced rate of 10% for basic rate taxpayers and 20% for higher rate taxpayers. So any gains over your capital gain tax allowance, you're a basic rate taxpayer that taxed 10%, and you're a higher rate taxpayer that we tax 20%. For properties, the rates are different. They're 18% you're a basic rate taxpayer, or 28% you're a higher rate taxpayer. Investment bonds are powerful tools to control when you trigger a tax liability, and their innate flexibility to change the investment strategy without triggering a tax charge makes them valuable for many investors, but particularly trustees who are typically exposed to higher rates of tax and reduced allowances. We'll have a look at the investment bonds at a later stage when I cover the trust and estate planning strategies and ways to manage them exposure to inheritance tax. But again, it's something to bear in mind. Investment bonds, you haven't come across those before. And of course, pensions, which are all about, to come out in more detail, is a fantastic tax investment wrapper. And Northern, basically, this has been put in place by the government to encourage us to save and invest for retirement. And the way it works is that the allowances that we have in place, they've been actually shrinking a little bit over the past few years, and it's critical that again you seek advice to ensure that you're making the most of the tax reliefs and allowances that are available for pensions here in the UK. So when it comes to retirement planning, we know that the reasons are simple, the challenges are complex. Okay, we are living longer, which is great, but how do you fund a retirement which is potentially as long as your career? Longevity is often underestimated by many, and the length of time the pension pot might need to provide an income in retirement. You can see the life expectancy, how it's continued to going up, and the projections for someone to live with a life expectancy for 65 years old. It's the breakdown by female and male. Okay, and here's another slide that illustrates a similar point. So a baby born in 2020, the chances of living to age 100. So the message, I guess, that we want to take away is that personal provision will be increasingly important. And broadly speaking, we should all be putting more away for futures. Reason being is because we are all likely to live longer than our parents and our grandparents. And the government, of course, is aware of it and is encouraging people like you and I to save more for the future. This slide looks at the relief that was available for the annual allowance for the pension. You see that back in 2010, 2011, you could save up to $250,000 into pension. Now it's been significantly reduced to, as you can see, to 40,000. That's the maximum that you can save into a pension each year. There's various different exceptions and rules around it, but I think on a high level, I have to keep it simple. At this point, the maximum that you can contribute to your pension, provided that you have sufficient earnings, is £40,000 each financial year. This is the lifetime allowance. It shows you the maximum amount that you can save within your pension without triggering a lifetime allowance charge. Okay, so as you can see, the lifetime allowances have again been squeezed by consecutive governments, and at the moment the lifetime allowance is £1,073,000, and this limits the size of the income that can realistically be taken. 40% in income is only £42,000, £43,000 that you could take each year if you would save up to over £1 million into your pension pot. I say 4% because we would deem as sustainable or income that you could draw from your pension without eroding the capital. Okay, but we can go into that in more detail. So the lifetime allowance is not just something that those approaching retirement need to be aware of. This might be, people might think it's not realistic, but actually high earners could be creating significant challenges in the future if they don't seek advice. And bear in mind that the lifetime allowance is currently only assessed against the person who owns the pension asset. Passing on a pension on death means that the pot is not added to the recipient's pot for lifetime allowance calculations, and therefore is exempt from their own lifetime limit based upon current legislation. So this is again really, really important consideration. So a pension still represents a really good option as part of a broad and diverse financial planning strategy. You've got tax relief on eligible contributions, tax efficient investment growth, 25% tax-free cash at retirement, flexible options for tax efficient income. It is exempt for inheritance tax, which is again really, really powerful, and offers a lot of flexibility for your beneficiaries in terms of how, if you were to die, how they would access your pension funds in the future. So it really is really, really powerful way to mitigate your tax exposure and save for the future. Let's have a quick look at a practical example of a personal pension that benefits. The rules have around death benefits and personal pensions make them far more flexible when you consider how they can benefit the next generation, your beneficiaries. And here's just an example I'm going to let you have a look at that illustrates this point. Circumstances might not be the same for yourself, but again, really, really important to understand that if someone dies before age 75, the pension would be passed to his or her beneficiaries tax-free, and it will not form part of his or her estate. If someone dies 75 plus, the pension will still not form part of the estate, but the benefits, the money that is still held in the pension will be taxed at their marginal income rates. Okay. So look at children's pensions as well, just like the junior ISAs. Again, this is a really, really good tool to start utilizing tax for your children or grandchildren. The annual allowance, again, is 2,000. You could contribute to 3,600 into pension tax-free. So 2,880 net. With the government top-up is 3,600 that goes into your pension. And of course, you wouldn't be able to access the pension until the age 55. But again, it's a really great way to help save for the future of your children or grandchildren, whilst you're reducing your the size of your estate, or potentially mitigating a future IHT liability. Okay, these are the 4 pillars of tax efficient investing. Okay, we looked at the ISAs, the pensions, kind of a quick look at the VCTs and the EIS. I'm just conscious of the time. We want to make sure we've got enough time to take some questions at the end of the presentation. So we're going to have to go through some of this slide a little bit faster. But just to give you high level overview in terms of what the venture capital trust is and an enterprise investment scheme is as well. Let me show you first of all where you claim the tax relief, in this case for you subscribe for a venture capital trust or an enterprise investment scheme. This is part of your self-assessment. Okay, but let me just walk you through some of the benefits and and the rules in terms of how these schemes actually work, in case you are not familiar with them. EIS, Enterprise Investment Scheme, Venture Capital Trust, they can both help manage income tax liabilities, as they qualify for a 30% relief against your income tax liability. The gains are free of capital gain tax, and you can actually reinvest taxable profits on the sale of another asset into an EIS and benefit from capital gain tax referral. This is really, really powerful. I'll repeat it again. You can reinvest gains of the disposal of an asset that might give rise to a capital gain tax liability into an EIS scheme and benefit from capital gain tax deferral. Doesn't mean that the liability will go away, but it'll be deferred. There are ways to defer the liability further and further into the future by reinvesting into EIS schemes over and over again. After 2 years of owning the EIS shares, you can also qualify for something that is called business property relief, which is an exemption from inheritance tax. With all these reliefs, it's worth exploring whether the high investment risks can be offset with a reduced liability to tax. The VCTs, the tax reliefs are only available to individuals aged 18 and not to trustees or companies. You have to hold a new VCT investment for a minimum of 5 years to benefit from the tax reliefs. The income tax relief is 30% for investments up to 200,000, EIS up to $1 million, exemption from income tax on dividends paid by the VCT, and this exemption from, again, capital gain tax on disposal of the shares doesn't apply to second-hand VCTs. But again, it is really important to understand the advantages of the VCTs, the holding periods as well. EIS is 3 years, VCTs are 5 years. And there have been further benefits in terms of, I haven't mentioned, in terms of loss relief with the EIS scheme, not with the venture capital trust scheme. But the one thing that's, I think, is important to highlight as well is that these are tax incentivized investment schemes that they might not be suitable for everyone. They do carry a high level of risks because the investments are placed into companies that tend to be small to medium-sized companies that are effectively looking to raise capital to grow and expand their operations. So it's important, again, to emphasize that it might not be suitable for everyone because it carries a higher level of risk, and also there might be a liquidity risk that investors will need to take into account when they're looking to sell the assets, as some of these investments might not be as liquid as if you invest in a company, say, that is listed in the London Stock Exchange, for instance. Okay. Business relief, again, this is really, really important. Applies business owners as well. Basically, the way it works is that in a business qualifies for 100%. Business relief means that there will be no IHT liability if you are the owner of a business. Again, it's really important. There's various different strategies that will work with clients to understand whether the business will qualify for business property relief or not. But from a inheritance tax perspective, it is a very powerful way to shelter some of your assets, your business in this case, from IHT liability in the future. So we've talked a little bit about IHT and estate planning. I think what you need to know without going into a lot of detail is that estate planning, it is something that sometimes it catches people off guard because they're not aware of the implications and the tax position when someone dies in the UK. And again, there is a lot of noise as well when you go to when you read the press and the media in terms of the tax liabilities and tax bills that more often than not beneficiaries have to pick up to be able to access the state of the deceased. So this is something that we work quite a lot with our clients to understand, what the correct position is, what would be the best way to transfer assets to the loved ones, whether they want to do it in the lifetime or whether they want to do it on death. And of course, there are always different options available. What it might work for one client, it might necessarily work for the next. But again, very important to seek financial advice to understand the various different options that might be available to potentially mitigate or eliminate an inheritance tax liability. Okay, I'm just going to explain a little bit more how it works. So there is something called the Nil Rate Band, which is £395,000. Hasn't changed that much actually in the past few years. But basically anything that is above your Nil Rate Band is currently taxed at 40%. Okay. There's also a primary residence, Nil residence band that was introduced in 2017. It's increased now to £175,000. But again, there are some caveats with this additional allowance, and it's only valid if you are giving your main residence to your children, to your loved ones when you die. Okay, so there's an extra £175,000 that is allowable. So for a couple, potentially best case scenario, you include the main home, you're looking up to 1 million, okay, that you could shelter from inheritance tax from HMRC. Anything above that would be taxed at 40%. So 40, just again, it's really high tax rate compared to some other countries in Europe and America. Still, it's really high. So it's something that you need to be mindful of. All right, so let's move to the next slide. There's various different exemptions and options available. So the spousal or civil partner transfer, if both spouses are UK domiciled. If one is not UK domiciled, it's limited to £325,000. There's certain reliefs depending on the assets that you're looking at. As I said before, if you own a business, that would be exempt, generally speaking, from an IHT liability. And various different gifts as well you can give during your lifetime. You can see small gifts value 250 per year to as many individuals. This annual gift as well, 3,000. Personal exemption rather, and it's not 3,000 per child, but you could break it up and give 1,000 to 3 separate children. Talk about wedding gifts as well, to 5,000 as a gift in consideration of marriage. Benefits here as the amount immediately reduces, of course, the size of your estate. And we're also looking at regular gifts out of income. Okay, there has to be out of income, out of regular expenditure. If it's not out of regular expenditure, it will be treated as a gift reservation. Okay, this is again important consideration. Not going to go into that in more detail right now because I'm conscious of the time, but again, really important to understand the various different options that you have available to reduce the size of your estate in your lifetime in a tax efficient manner. We do quite a lot of work for our clients in this space. Of course, the use of trusts, is another way to give away an asset and to retain some control over the asset. And in some instances, it's possible to retain access to capital and income. Within trust and estate planning, there's various different options available. We work very closely with solicitors to draft plans, trust deeds for clients, depending on this, the various different circumstances. There are ways to give away capital that you don't need, but in some instances you might be able to draw an income from your trust in a tax efficient manner. This is an opportunity to control, to have a degree of control in terms of how the gift is being shared with the beneficiaries. So there's various different options available. And again, I would recommend you seek legal and financial advice, because this is a very powerful area within financial planning. A few examples here in terms of, you can enjoy your life with a regular income whilst reducing the size of your estate. Without going into, again, a lot of detail, this is how for instance, a discounted gift plan would work. So it's basically an opportunity to gift an asset to reduce the size of your estate. So you place the gift into the trust, and then typically you would use an investment bond. So you use the funds to purchase an investment bond that on death, the amount that would be left over would pass to the beneficiaries in a tax efficient manner, but also will allow you to draw an income for life, which is, again, really, really powerful, and something that HMRC currently supports, and it's very powerful for people approaching retirement. So this is an example here. If you were to give £250,000 with 4% withdrawals every year, so you would draw an income of 4% every year from the trust. If you're age 60, for instance, there's very different calculations involved here. I'm not going to go into, but it would basically reduce the size of your estate quite significantly. So you would effectively save immediately £55,000 in this case, if you are age 60 and you place a £250,000 investment into a trust. Okay, so this is just an example. So in summary, I know we've covered quite a lot of ground, and I could go on for ages, but conscious of the time, we looked at the ISAs, and I think key takeaway: are you making the most of this year's £20,000 ISA allowance? And have you thought about, you have children and grandchildren, have you thought about the £9,000 junior ISA allowance? Your personal savings allowance, remember, is 1,000 if you are a basic rate taxpayer, 500 if you are a higher rate taxpayer. Pensions, are you getting the most of the tax efficient benefits your pension can bring? This is really, really powerful. Pensions is the best way to invest for your future. You will not find a more tax efficient way to invest for your future than a pension in the UK right now. Capital gain tax, are you going to make use of your 12,300 GDT allowance? It is for the liability. There's different options potentially look at to reduce your capital gain tax allowance. Think EIS and VCTs. Dividends, the first 2,000, tax-free. Inheritance tax, we looked at various different ways to reduce the size of your estate in your lifetime. So yeah, just to wrap up, the purpose of the webinar again is to give you a good overview of the tax considerations for this tax year. Whoever will have unique circumstances, and therefore it's always best to have a review to understand your own situation. One of the tools we use is a tax health check. This is a set of questions we'll run through to determine your current tax health and to identify either any areas where you could potentially make improvements if this is something you would be interested in, I think Hannah will share my contact details with you at the end of the presentation. So please feel free to ping me a note or an email, or give me a call. I'm more than happy to discuss your own personal tax circumstances, tax planning opportunities in more detail. So that brings me to the end of my presentation. I know we've covered a lot of ground, but let's see if we can answer some of the questions that you might have. Hannah, over to you.
Brilliant. Yeah, thank you very much, Luis. That was very, very informative. So much information in there. If anyone does have a question and would like to ask it now, please do go ahead. As I mentioned before, you can use the chat function or the Q&A there. Okay, Luis, one we've had is post-Brexit in relation to non-resident taxes on rentals for UK fiscal residents in Spain. Who does the UK-Spain dual tax agreement reconcile with the fact that gross rental should be considered? You can see this written down, Luis, if that helps. Has there been any updates, or is there any plan for the UK to update this matter as other non-EU countries have done? Thank you.
Sorry, I can't see the question.
Right.
Oh, sorry, yeah, I got it here. Just 1 second. Yeah, this is quite a complex.
A long one.
Yeah. Okay, post-Brexit. Okay, this is a fairly complex. Thanks, Martha, for your question. It's a fairly complex area. I'll probably say that get in touch with me and we'll look at your circumstances in more detail. The reason being is because it happens to a lot of our clients. If you have assets or interest in a different jurisdiction, we need to look at your status in the UK, whether you are a UK resident and whether you are a UK domiciled or not. So there are two different aspects that we need to take into account. And then we also need to look at where the assets are based. If in this case they're based in Spain, we need to understand who is the owner of the assets. And then there is something that is called double tax treaty, that there is a double tax treaty between the UK and Spain, meaning that depending on the tax liability that might be triggered in Spain for a UK resident that has an interest in Spain, in this case, in a third country, effectively you wouldn't have to pay the tax twice, okay? But again, depending on your domicile status in the UK, which I haven't got time to go into right now, there might be an option to keep the returns in Spain. You don't have to bring them to the UK, so you would only pay tax in Spain. But if you wanted to bring them to the UK, then it would be subject to tax in the UK, but whatever tax you paid in Spain, it would be discounted from the tax if there would be any further tax you have to pay in the UK. But happy to take that question with you separately, because it is quite a complex one. Thank you.
Thanks, Luis. And yeah, I certainly will. As we said before, after this session, I will share Luis's contact details with all of you who've connected, so you can get in touch with him about these questions. Okay, Luis, a question about the ISAs, which you've covered. Someone has asked, do I need to declare my ISA on my self-assessment tax return?
No, you don't. You don't need to declare your ISAs. Your ISAs are, it is a tax wrapper, so any growth or any income within the ISA is 100% tax-free. That's the beauty of it. So it will not give rise to any tax liability.
All right, brilliant. And a final one I can see for now that we've had, although please do feel free to write in if you like, we still have a little bit of time. It's another quite an ISA related one. Someone's asked, are there any restrictions on the number of ISA transfers I can make a year?
There are no restrictions as such. It depends on your ISA provider. You should be able to, if you want to transfer, you want to change your ISA provider, you should be able to do so. I guess the question is, why would you be looking to transfer from one ISA to the next? What would be the reason to do it? If there's a good reason, absolutely fine. It could be that maybe it's not the right investment strategy, or you're concerned about the fees or the charges, but generally speaking, people wouldn't be switching from one ISA provider to the next within the same fiscal year, unless there is a really good reason to do so.
Great. Okay. Okay. And then just one other question we've had so far. Someone's asked, if I have a financial or an investment plan, how often do you recommend I have it reviewed?
So that's a great question. Typically, the way we work with clients is that we will have a review list once a year. But if there is a change in your circumstances, getting married, a new job, looking to buy a property, or health scare, God forbid, you should reach out to your financial advisor if you have a financial advisor immediately, because there might be adjustments that we need to implement within your financial plan, and it is something that we recommend to all our clients. That's the beauty of the ongoing financial advice, that it has to adapt to your changing circumstances, as you evolve and as you grow.
Fantastic, thank you. Well, yeah, again, for the final time, repeating myself a bit, but if anyone has any other questions, or there's one you'd like to ask to Luis, aside from this webinar, I will send you his contact details so you can get in touch with him and ask that. I'm sure he'd be delighted to hear from you. And yeah, thank you again very much, Luis, for sharing all this insight with us this morning. It's been really, really useful and informative, and thank you to all of you who've joined us. Yeah, and the recording of this webinar will soon be on the YouTube channel of the Spanish Chamber. So if you think a colleague or contact of yours might be interested in it, please do feel free to share it with them, and keep an eye out for other chamber events that we've got going on. There's a lot going on in this month and the next month. So yeah, so thank you so much again, Luis, and yeah, we hope to see you all soon.
Thank you. Thank you.
Thank you. Bye-bye.